Peloton reported quarterly financial results today that sent the stock price soaring on October 31st. I'm happy about that because Peloton has been one of the stocks I've been recommending as a beaten down growth stock that investors could take a chance on because the risk versus reward was attractive in my opinion. So now that Peloton stock is up 34% year to date, is the stock still a buy, or is it time for investors to take profits in this interactive home exercise company? I'll review the company's latest financial results, compare it with the new valuation, and answer what I think about the stock in terms of it's a buy, hold, or a sell. Let's get into it. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, Peloton said that they had a strong first quarter and performed above their guidance in all of their critical metrics. We're especially pleased with their bottom line results with free cash flow and achieving their cost-saving targets faster than they expected as a result of strong execution by their Peloton team members. So good to hear that the company had an excellent quarter, but let me zoom out a little bit and discuss why Peloton got into trouble in the first place. During the pandemic, of course, when gyms were closed and people were spending more time at home, Peloton's demand from its customers absolutely exploded. They had been growing revenue by over 100% each year for 6 straight years, even before the outbreak. And then during the pandemic, sales exploded by even more than that. The wait list to receive your Peloton was approaching 10 weeks and people were still ordering. So management got a little overconfident and they thought, well, customers love our product. They're always going to love our product. We need to invest in growth. We need to add more manufacturing capacity so that we can serve all of this customer demand, because this is what our demand is going to look like. Even when economies reopen, even when gyms reopen, people are still going to want our bikes. And that was the big mistake that the previous management team made, is to think that demand for its products would continue to be very strong even when gyms reopen. And that turned out to be an incredibly wrong assumption to make. When gyms reopened, demand for Peloton's products collapsed. And to make matters worse, the company had just invested roughly $1 billion to add all of this new manufacturing capacity when demand was coming down. And so that put the business in a really bad situation. And they've been since trying to recover from that poor decision, or I shouldn't say poor decision, but poor assumption about consumer demand during the time when gyms were closed. And so now they're recovering. They're finally at a pace where they're delivering positive cash flow from operations. So now that I've provided the backstory of why the company got into trouble in the first place, let's proceed with what's going on in the most recent quarter. So Peloton said they're improving their unit economics across all products, sales channels, and markets in pursuit of profitable growth and meaningful free cash flow generation. And that's good to hear. That's the strategy I recommended for Peloton. I thought if they were to implement a strategy where they just reduced production of the actual equipment and raised prices so that, even if they're getting fewer sales, at least those sales are break even. And then the other side of the business, which if you don't already know, the people that buy a Peloton bike, they also buy a subscription to the live and recorded exercise classes. And that part of the business is very lucrative. It generates profit margins above or close to 70%. And so I thought, and I suggested, if they can just get that physical production, manufacturing shrunk to a level that meets current customer demand, and then just profit from the subscription business, and then just sell bikes at a higher price, enough to generate a positive margin, and then get the real margins from the subscription business. And that's what they've been working on, to shrink the manufacturing capacity, get rid of a lot of the inventory they had on hand, and focus more so on becoming self-sustaining, at least generating positive free cash flow, so that the business is not at risk of going bankrupt, which they were at risk about a year and a half ago of going bankrupt, because They had so much debt on the balance sheet, and they had all of these commitments to manufacturing, all this overhead, and it wasn't sustainable. So thankfully, they've got themselves in a better situation. Their cash flow from operations in the latest quarter was 12 million, and that was up by 92 million from the same time in the same quarter last year. So in the same quarter last year, they were still negative significantly on cash flow from operations. To achieve that target, they decreased operating expenses by over 126 million year over year. And in the first quarter, they raised the recommended retail price for the Bike and Bike Plus product in the international market. They also increased the retail price in the rest of the world and in North America, or I should say their Row product in North America, reducing promotional activity across their hardware portfolio compared to the same quarter last year. All of which I thought was a good plan, good idea, right? Just raise prices. Even if you get fewer sales, at least the sales that you get will be profitable. And then those people will subscribe to the monthly subscription, which has a very low churn and cancellation rate. And you can bring your business down to a sustainable level where at least every quarter you're generating cash flow. You might not be growing the business very quickly, but that's not the focus you should have when your business is in this much danger. Another thing they did is reduce sales and marketing expenses by 64 million. And this is primarily driven by a historically low media spend in the quarter. So they're intentionally lowering spending, increasing prices, and they understand that it's going to mean slower growth, but they're okay with that because they want to get their business on sustainable footing. I recommended a similar strategy to this one with, if you follow a company called Fubo TV, they're also in a position where they're losing so much money on each customer that I've recommended what they should do is just raise prices a lot to get the business on a sustainable footing, even if it means they're going to lose some customers, even if it's going to mean slower growth, because this is not a good time to have such significant negative cash flow and to have your business be in such a position because the cost of capital is so much higher. Investors are not willing to fund these types of unprofitable growth companies indefinitely anymore. Investors are more interested in sustainable businesses that can function on their own without always needing investors to put money in, right? And so I think this is a prudent strategy from Peloton. Fubo TV could take notes from Peloton, perhaps employ a similar strategy. So I highlighted earlier the difference between the products business and the subscription business. And you can see in the products business, connected fitness product revenue versus connected fitness product gross margin just at 9.2% compared to the subscription gross margin of 67.8%. And this product gross margin of 9.2% was up almost triple 3.1% in the same quarter last year. So they've made huge strides on that side of the business. This is the side of the business that was under most pressure. And so the improvement in this part of the business is what really got investors enthusiastic about Peloton stock. And that's why the price is up so much year to date in 2024. And then now the business is on sustainable footing, free cash flow positive in 2 straight quarters with meaningful cash flow. Net cash flow from operations in the last 2 quarters of close to $45 million and free cash flow in the last 2 quarters of over $36 million. So from now on, I think they can be comfortably cash flow positive with this current model of higher prices, lower marketing spending, accept the fact that you're not going to grow the business as quickly. You might not even grow the business at all. You might be experiencing a decrease in revenue, but your cash flow will be positive, your free cash flow will be positive, and you can buy yourself more time to get your business on a better footing. And then once you get your balance back, then you can focus on growth opportunities in the future. Right now is not the time for that for Peloton. Right now is just the time for getting stable, getting their feet under them, and then they can focus on growth later, which I thought was a excellent strategy, brilliant strategy to save this company from the brink and bring it back to this point. It took a lot of effort, a lot of work for the company. This was not an easy thing to do. So kudos to Peloton, the team members, and management for getting the company to this. It's now trading at a forward price to sales of 1.234, which is the most expensive this stock has been year to date in 2024. So I'm happy about the gains in 2024 as I've had the stock rated as a buy. And if investors bought, they made some money, which always makes me happy when my viewers make money from research that I conduct. So to update my recommendation of Peloton stock, I'm actually downgrading the stock because of the increase in price. The company has benefited already from the big price increase by saving the company from the disaster, right? That was the biggest reason why the stock price had fallen by so much, is because of the risk of insolvency, the risk of bankruptcy, and it looks to have jumped up from that level. It's now comfortably above the level where it's not really at risk of going bankrupt anymore, and that's causing the price to jump higher. The difficult going remains, and so with the current valuation, I think the stock is just a hold now. It's not a buy anymore, in my opinion, at current prices. And I'll update that recommendation on October 31st, 2024. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.